All right, accounting for income taxes, okay? Now, the purpose of this chapter is not to teach you how to do income taxes, okay? But the purpose is more along the lines of this right here. Ever since you started accounting 220, we've been doing accounting based on what method? The accrual basis method, right? And with accrual basis, that's just a simple word for saying, hey, we're going to record the impacts of cash, whether or not we receive it. So, for instance, go back to your statement of cash flows. If you have a sale, you have revenues. Revenues are comprised of cash plus a promise to pay, that promise to pay being accounts receivable. Now, it's pretty guaranteed if I owe you $20 on something in accounts receivable, you're going to get it, right? But if you don't have that money in your hands, how would you like it if the IRS taxed you? That wouldn't be exactly right, okay? So for income tax purposes, we do what we call a modified cash basis, okay? And it's kind of the same as the statement of cash flows, where we take out certain impacts of non-cash or of items that have not resulted in a transfer of cash. That's all we're pretty much doing. And with that, we set aside a tax rate only to that. Now, for instance, if you happen to have more money on your books than you have for your taxable income, then sooner or later you're going to be able to have to pay taxes on that. That'll create what you call a deferred tax liability. That's the first thing we're going to look at. Okay, so let's start looking at this right here on page 935. Let's look at let's look at the top of this example here. All right. Illustration 16-1. We have for the year 2016. How much do we have in terms of our revenue, in terms of our pre-tax income? $140 million, right? And of course, that's revenues minus all expenses equals pre-tax income, okay? But in here, we're going to take apart the revenue section. And what they're saying is that out of all the revenues they received, well, they had $40 million on there that they did not receive. So what are we going to do with that? Well, since we did not receive 40 million of that in our hands, we're going to back that out. And that's what I said a second earlier. We're not going to pay taxes on that 40 million. Does that make sense? In terms of why? You don't have it. Now, of course, under the accrual method or under the book basis, or if you use QuickBooks or whatever, on your books you'll have $140 million. But for your tax income, you're only going to show $100,000 or $100 million in this case. Now, with that 40 million, I know you expect to receive it later on, right? When do you expect to receive it looking at the bottom? You expect to receive some in 2017, and how much do you expect to receive in 2018? 30. So at that point in time, those differences are going to do what you call reverse, meaning that it's going to go from something that we don't have now to in the future we're going to actually have it. For that reason right there, we will pay taxes on it when we get that, okay? Any questions about just the general setup? Because that's pretty much all we're going to look at, except we're going to change examples every time we get into something else. All right? So that's going to create what you call a future taxable amount. Your pre-tax taxable income in the first year will be $100,000. Okay? When you have that $40 million that's going to come in later, you'll still have to pay taxes on it. As we'll see a little bit later on, we'll see the tax rates that you use. Let me give you an example of what we'll see later on. Right now, we're talking, the country's talking about changing tax rates, correct? Let's just say it's pretty sure it's going to happen. Okay, so in 2018, they're pretty sure they're going to change the tax rate. Since we know that, shouldn't we go on ahead and account for that at that point in time using that tax rate? Not exactly. Even if we're 99% sure, the tax rate must be what you call enacted. It has to have been passed. It has to be there because anything can go wrong, okay? So it has to be enacted. That's just another example of how your question is set up. Yeah, we're pretty sure. You say trying to lean you over there. We're pretty sure it's going to happen. No, you're looking at something that's enacted. If it's not enacted, it doesn't matter. So, of course, in this case, the tax rate is assumed 40% at all 3 years. So we're just going to keep it that way. That's no problem here, okay? Now, from that, the whole purpose of this is to get this in our financial statements, which means we must do something that you've done since 200, which is to journalize. How do I journalize this, okay? Look at this closely. Taxable income. You're always going to have the enacted tax rate. So you multiply that times the tax rate, and you'll get 40%. That is your taxes payable currently. So you're going to debit that. Income taxes payable. That makes sense, right? Correct? Okay. The next part, we're going to look at what we're going to have to pay in the future. Remember, on my books, I show 140. for and I know I'm going to get it, but I'm not going to pay it on the 40 million that I don't have, but I'm going to have to pay that win in the future. So that's why I'm going to defer that liability, which means that's a credit. We always increase our liabilities through a credit. So that's why we have deferred tax liability of a credit of $16 million. Now, you have to get those two right. You have to get that. And this is one of those rare times, once again, I'll say, well, it's the income tax expense is going to balance. It has to. That's why we have $56 million. Now, I know you look at it and say, well, I could have taken my $140 million and multiplied it by the tax rate of 40% and got $56 million. Try it. It'll work in this case. Okay? But the thing is, what if you have an inactive tax rate that's going to come up later? So for that reason, always compute your income tax payable, which is simply looking at your taxable income times the tax rate, and then compute your deferred tax liability. You don't know what you'll know what that is based on however many different tax rates you have, and from there you have to get those two right to get your income tax expense in most cases. Okay, so this is one of those rare times once again where you cannot compute income tax expense first. You have to look at it and get that from the summary of the others. Any questions about that right there? Okay. Does it jog any questions about your Learn Smart? Yes, sir.
One concept I kind of didn't get, like typically if you owed money, typically you would want to pay that off as soon as possible, but like with taxes, they're wanting to put them off for as long as possible. Why is that?
You need more money in your business to run it, right? So the longer we can put off paying those taxes, that's a good thing. And we're going to come to something in a second where we're talking about with net operating losses. Is that more so what you're talking about at that point in time? If not, that's okay. We'll come to it. With net operating losses, let's say you have a loss this year, right? You have the option to either go back 2 years and literally recover the income taxes up to whatever your loss is, and then the rest of it you can carry forward, or you can say, hey, look, I'm just going to carry this forward and receive what you call a deferred tax asset. Now, in this case, it's kind of similar to what you're saying. Well, why don't I go back and get my income and get me some cash in here instead of just putting it off later? Well, let's say I have a rental house business, right? And I don't have all my tenants in, but I know I'm going to have some tenants coming up. So I might choose to actually, delay that and get a deferred tax asset later. But let's say I'm in a business where I have inventory. Well, if I'm not making money, it's probably because I have the wrong inventory or I need some inventory, period. In that case, I'd rather go get the refund, buy the inventory that my customers want, and then do it. So does that kind of help you out in terms of why? It just depends on your situation. But that's a good question in terms of how you look at it, though. Okay. Yes, sir?
You know how people, right before the end of the year, they'll go out and buy a piece of property or a car or something like that? Is that to be in a different tax bracket or just to have less taxable income?
Both. If you have less taxable income, then you could possibly be in a lower tax bracket. This is not a good year, but in terms of what I want to say, it's not a good year. So let's go back to 2008 when you had the economic crisis, right? You this person who's way up there, right? And you have a very high tax rate. Well, around then, that's when the stock market kind of went down. And remember we talked about unrealized losses. It's unrealized until you sell it. So I'm in this tax bracket here. I got this money in the bank that's gonna, I may have lost $20,000. Well, if I can, sell off enough for that to get me in a lower tax bracket, all of a sudden I'm paying less taxes. So you see what I'm saying? Does that kind of help you out there?
Yeah, it just keeps.
Yeah. Right. And of course, with your business, that's why sometimes you see these LLCs set up. You might have a whatever LLC it is that you have. And with that expense, of course, some things you have to depreciate, so you may or may not get the full benefit. But if you can drop your income down for that purpose, you needed it anyway. You needed a new computer for you, a new 5 computers for your employees. Some people may go ahead and do it. What you're looking at is what you call sometimes, which we don't cover in here, earnings management. You ever heard of that? And basically, it's a system where there's nothing wrong with doing it. But say, for instance, your computer system needs this annual maintenance. You schedule to do it every December. Well, on the flip side of what you said is, well, I need to look profitable this year, so let's do it in January. So my expenses hit January. It's not illegal, but basically what you're telling me is that your income looks better this year, and it really didn't. We just push our expenses off. So, those are things, earnings management type things, and I can get you a lot more on that because that's not something that no intermediate class pretty much covers. But to be aware of that, that's why they say, yeah, you can go here and prepare these financial statements and do these ratios, but there are some other things that kind of go on in there, and sometimes we just don't know. Okay. All right. Any more questions? Okay. So that's our deferred tax liability. Remember, please don't make the mistake of always computing your income tax expense first. You may be right, you may not be right. You just never really know, okay?